Good afternoon, friends. In the subject of personal financial planning, we are starting and we are talking about the tax deductions. That is, for any personal financial planning, it is very important to have proper tax planning. If you plan your taxation properly, you will able to minimize your tax liability within legal means by proper tax planning. And for that, in today's lecture, I'll be talking about tax deductions. That is, there are certain investments and there are certain expenditures. If you incur those expenditure or if you make investment under certain heads, then by making those investment or by making those expenditure, you can reduce your tax liability. That is, whatever you invest, that will be deducted from your total income up to a particular limit, and your taxable income will get reduced, thereby your tax liability will also get reduced. Similarly, there are certain expenditure, if you incur those expenditure, it will be deducted from your total income, and thereby for the purpose of calculating taxable income, your taxable income will get reduced by that amount which you incur under those heads, and the tax liability will get reduced. So for that purpose, we will be talking about there are different type of tax deductions which are allowed under the Income Tax Act. One or two I discussed in my previous lecture on the tax exemptions and deductions also. I am quickly referring them. One of the most important tax deduction is under Section 80C. What is this Section 80C? Under the Section 80C of the Income Tax Act, if you make certain type of investments, then those investment are eligible for the purpose of calculating the taxable income. That is, those investment up to a particular limit of 1.5 lakh rupees will be deducted from your total income, and after deducting that 1.5 lakh rupees, if you have made that investment during a financial year, your taxable income will be calculated. So what it means is, under Section 80C of the Income Tax Act provides provisions for tax deduction on a number of payments with both individuals and Hindu undivided families. Friends, in this lecture, my focus will be on the individual tax planning. So I'll be more talking about the individual point of view. What are the deductions that are allowed for an individual and the HUF. So these deductions which I'm going to talk of under Section 80C, that is available for an individual and Hindu undivided family. Eligible taxpayers can claim deduction to the tune of 1.5 lakh rupees per year under Section 80C. With this amount being a combination of deductions available under Section 80C, 80CCC and attached under Section 80CCD, means under all these three heads, that is Section 80C, 80CCC and 80CCD, the combined deduction that is allowed is 1.5 lakh rupees. It doesn't mean that only under Section 80C, that is, if you are getting deduction under 80C also, 80CCC also and 80CCD also, I'll be referring those, right? The combined of this is 1.5 lakh rupees. You can take either under Section 80C only, right, or you can take in other heads. So what are these popular investments which you can make for the purpose of tax deduction? Payment made towards life insurance policies for yourself, for your spouse or for your children. If you are taking a life insurance policy, most of us do take life insurance policy because the life is very uncertain. So if something happens to a member of the family, especially the earning member or the spouse of the person, that is, if the earning member something happens to it, how in the future the economic needs will be taken care of. So for that purpose, you take the life insurance either for yourself, or you can take for your spouse, or you can take for your children. So premium paid for the purpose of life insurance is deductible up to a particular limit. That limit is, overall limit is 1.5 lakh rupees. So this is one payment, or you can say this is one investment rather, I would say. Payment made toward a superannuation or provident fund. that is the contribution which you make for your superannuation, means for your retirement planning or for your in your provident fund account, that is also that also counts in this category. Tuition fees paid to educate a maximum of 2 children. If you are paying tuition fee for your children subject to maximum of 2 children, that is also being considered under section 80C. Repayment of principal amount of a housing loan, right? So that is, if you are paying a principal amount under the house, you have taken a housing loan, and for that you are paying a principal amount. That is, if I have taken a loan of 50 lakh rupees, and out of that every year I am paying say 3 lakh rupees, 5 lakh rupees. So subject to a maximum of 1.5 lakh rupees, and this again 1.5 lakh is the overall limit, in the sense in all these heads combinedly the limit is 1.5 lakh rupees. But whatever the principal amount I am paying up to subject to a limit of 1.5 lakh rupees, that is deductible from my income for the purpose of calculating taxable income. Payment issued toward a fixed deposit with a minimum tenure of 5 years. That is, if I make a fixed deposit, right, and this fixed deposit tenure should be minimally 5 years. It cannot be for 2 years, 3 years, 4 years. So only those fixed deposits in the banks which are made for minimum period of 5 years that will be considered under this category. This section provides for a number of additional deductions like investment in tax saving, mutual funds. There are certain mutual funds. I mean, not all mutual funds qualify under this section. Only tax saving, there are specific type of mutual funds, schemes rather I would say, which are called tax saving schemes. Only those schemes which qualify under this tax saving schemes, they will only qualify under this section 80C. Post office saving scheme, senior citizen saving scheme, purchase of NABARD bonds, that is National Agriculture Bank for Rural Development. These are the certain, a few I have listed here, that these are the certain investments. If you make these investments, they are qualified for claiming deduction under section 80C. Friends, let be very clear that either this deduction can be under one head. Supposing I have made a fixed deposit of 1.5 lakh rupees in a particular year, so for 5 years, right, in a scheduled commercial bank. So this amount of 1.5 lakh rupees is the maximum limit under all these heads. Suppose I make contribution in provident fund also, I am paying some housing principal amount also for my housing principal loan which I have taken in the past, or I have made some post office deposits in the post office. The sum total of all these investments, rather I would say, should not be exceeding 5 lakh rupees. I make the investment under these different heads, but what is deductible amount that is permissible is maximally 1.5 lakh rupees. So now coming to the section 80CCC. Section 80CCC of the Income Tax Act provides scope for tax deduction on investments in pension funds. These pension funds could be from any insurer. When I am using the word any insurer, it means the private insurers. And a maximum deduction of rupees 1.5 lakh rupees can be claimed under it. This deduction can be claimed only by individual taxpayers. That is HUF, Hindu undivided families are not entitled to claim deduction under this section. Under 80CCC, only the individual taxpayers are allowed. And again friends, I am telling you, under 80C, 80CCC and 80CD, that is this section 80CCD, the combined of all these three can be maximally 1.5 lakh rupees, right? So under section 80CCC, if you make investment in any of the private pension funds, that is also eligible for the purpose of calculating taxable income, that is up to the ceiling of 1.5 lakh rupees, that is deductible from your total income. Say for example, my total income in a year is 30 lakh rupees. And if I make investment up to 1.5 lakh rupees under all these three sections, that is 80C, 80CCC and 80CCD, the maximum deduction that is allowed under these three sections will be 1.5 lakh rupees. That is 30 lakh rupees minus 1.5 lakh rupees which I have made contributed or which I have made investment under the various heads which I am talking of. And then it comes to section 80CCD. So this section 80CCC is for private pension players, right? If you are making contribution under any private pension scheme. Under 80CCD aims to encourage the habit of saving among individuals providing them an incentive for investing in pension schemes which are notified by the central government contribution made by an individual and his or her employer. Both are eligible for tax deductions, subject to the deductions being less than 10% of the adjusted gross income or 10% of the gross salary of the person. Only individual taxpayers are eligible for this deduction. When I talk of adjusted total income, what it means is that the income includes my salary plus my DA, right? And plus commission if I'm a private employee and I'm getting some salary, some commission on my sales or something like that. So commission, this constitutes the adjusted gross income, right? So this doesn't includes my perks and other things. So 10% is the maximum amount that is permissible, but the maximum total is subject to limit of 1.5 lakh rupees. So these are the three sections 80C, 80CCC and 80CCD in which you are allowed to have a deduction up to 1.5 lakh rupees for the purpose of calculating taxable income. Means whatever your total income is, if you make investment maximally up to 1.5 lakh rupees, right? So that will be my taxable income will be 30 lakh minus 1.5 lakh, that is 28.5 lakh rupees will be considered as my taxable income. Now comes section 80CCD1, right? There is also deduction allowed under 80CCD1. All individuals who have subscribed to the national pension scheme will be eligible to claim tax benefit under section 80CCD1 up to the limit of 1.5 lakh rupees. In addition to that, an exclusive deduction for investment up to rupees 50,000 in National Pension Scheme Tier 1 account can be availed by the subscribers under section 80CCD1B. So, dear friends, there are two sections. One is section 80CCD1 and the other is section 80CCD1B. If you are an individual person, individual employee, or if you are having your own business, if you are in a profession, right, and you want that after a particular age, when you will not be earning person, means your working age or your working beyond a particular age, when you feel that you are not able to earn. Suppose you are working in a private company where there is no pension scheme, right? So you want that after the age of 60, when you will get retired, or whatever the age of retirement your company has, there are certain companies which even retires in the age of 58, right? So after the retirement, you want that there should be some regular income. And for this regular income, the Government of India has started National Pension Scheme. Under this scheme, each month you contribute some sum of money, right? And that sum of money will be accumulated up to the age of 60. These days, even you can extend it, but I'm presuming you stop at the age of 60, right? So, I mean, earlier the maximum limit in which, maximum means the age in which you can contribute was 60 and subject to extension of 5 years. Now, even this age group has been increased, that you can keep on investing under the scheme even in the age of 70 also, right? So, you invest in that National Pension Scheme every month or every year. So that is also deductible from the purpose of calculating taxable income. That is up to 1.5 lakh rupees. If you contribute in National Pension Scheme, that is deductible under section 80CCD1. Apart from this 1.5 lakh rupees, there is an additional tax benefit, means tax deduction, that is allowed is under section 80CCD1B, in which if you invest 50,000 rupees, up to the 50,000 rupees, you can invest even 5 lakh rupees, but maximally allowed for the purpose of tax deduction is 50,000 rupees. There is no limit of investment, but for tax purposes, what I am talking in this lecture is specifically only for tax purposes, for the purpose of calculating taxable income. Friends, we should be very clear in this, that why we are talking of this tax planning. We are talking of tax planning because if you plan your taxable income, that is, if you plan your tax properly, you will able to save more, because if you are able to make good tax planning and thereby saving your tax liability. Thereby you will have additional income in your hands, and this additional income you can either consume, it will be remaining for your consumption, or for your investment, so that you can earn more. This is what financial planning is all about, right? So apart from this 1.5 lakh rupees under section CCD1 1B, if you invest up to 50,000 rupees in tier 1 account, see, under the national pension scheme there is tier 1 account, tier 2 account. Tier 1 is basically where the investments will be in the equity shares, right? So if you invest in the tier 1 account, additional 50,000 rupees is permissible for the purpose of deduction, that is your total income minus this investment of yours, is then the tax liability will be calculated. So I can claim up to 2 lakh rupees, 1.5 lakh rupees if I have invested in the pension scheme, national pension scheme, and apart from the 1.5 lakh rupees, additional 50,000 rupees is being invested in the tier 1 account, then this is permissible under section. Like if supposing I am a government employee and I am investing 1.5 lakh rupees in my provident fund account and all those accounts, so thereby I am claiming deduction of 1.5 lakh rupees under section 80C. Apart from this, I am also investing in national pension scheme tier 1 account to the tune of 50,000 rupees. So my total income minus 2 lakh rupees, right? On that amount, my taxable income will be calculated. Tax deduction under section 80D, right? So section 80D of the Income Tax Act permits deduction on amounts spent by an individual towards the premium of health insurance policy. This includes payment made on behalf of a spouse, children, parents, or self to a central government health plan. Friends, as all of us know these days, the health has become, the medical expenditure has become, or medical has become very expensive. If you go to any private hospital and for any treatment, ailment, there is any ailment, and if you go for the treatment, the medical expenses are quite high. So from the financial planning point of view also, it is always advisable that you must take a health insurance policy. That is, you must pay a premium every year for any health ailment that takes place. So the medical expenses will be taken care by that insurance company up to a particular limit for which you have taken a policy. Suppose I have taken a health insurance policy to the tune of rupees 10 lakh rupees, right? So it means, what it means is that if anything happens to me, means any ailment takes place, I am being hospitalized for that, an individual is being hospitalized for that, an expenditure, a medical expenditure up to 10 lakh rupees will be paid by the insurance company. For that, insurance company will charge a premium from that individual, which is normally on an yearly basis. It may be 6 months. It means in yearly in premium amount has to be paid. So if you take insurance policy, that is health insurance policy, for yourself, that is for the self, for your spouse, for your dependent children, right? So the maximum deduction that is allowed is 50,000 rupees. So if I am paying, say, 75,000 rupees for the health insurance of my family, which includes myself, my wife, my children, my parents, so the maximum deduction allowed is 50,000 rupees, right? Not 50,000 rupees, it is 25,000 rupees. An amount of rupees 25,000 can be claimed as a deduction when paid towards the insurance for a spouse, dependent children, or self. Not 50,000 rupees, it is 25,000 rupees. But if my parents are senior citizens, right? So insurance policy taken for the senior citizen under section 80D, the income tax deduction limit for senior citizens had been increased to 50,000 for medical insurance, right? So means if a person is up to an age of 60, then the health insurance can be taken up to the rupees 25,000 rupees. You can take any amount, health insurance premium of any amount, but maximum deductible amount allowed under the Income Tax Act is 25,000 rupees. But for senior citizen, if a person is of 60 or plus age group, then this deduction allowed is 50,000 rupees for medical expenditure, right? So both individuals and Hindu unified families are eligible for this deduction. subject to the payment being made in modes other than cash. Friends, this is very important that when you make this health insurance premium amount, the payment must be made not in cash form but in digital form. It should be either in check form or any other digital form, right? For senior citizen parents, see, apart from this 50,000 rupees or 25,000 rupees, 25,000 if you are less than 60, 50,000 rupees if you are 60 plus, that is more than, so health insurance for that. Apart from this 25,000 or 50,000 as the case applicable, if an individual takes health insurance policy for his or her parents who are senior citizens, that is who are 60 plus age group, suppose a young person 25 years of age, right? He takes a health insurance plan for himself and his spouse, or the lady takes for herself and for the spouse. 25,000 rupees is allowed, right? And if that person has a senior citizen parents having age group of more than 60, then this for parents, the 50,000 additional amount is allowed for health insurance. So for senior citizen parents, insurance and additional 50,000 is allowed under section 80D. For what it means is, friends, if an individual who is in the age group of 25, he takes the health insurance premium, he paid the health insurance premium up to 25,000 rupees, that is deductible. Plus, apart from this 25,000 rupees, if he also takes health insurance plan or he paid premium for the parents' health insurance who are senior citizen, who are more than 60 age group, right, then this additional 50,000 will be allowed. That is 25,000 for himself or the spouse plus if a child is there or children are there, plus 50,000 rupees for senior citizen parents, right? So apart from this, even 5,000 is allowed every year for preventive health checkup. These days, the doctors advise that everybody should go for preventive health check because, nobody knows what is happening inside the body, what is happening, what is my blood sugar level, what is my other things, right? So it is always advisable to go for health checkup on a regular basis. And if you spend 5,000 rupees on for your health checkup, we call it normally preventive health checkup, right? Routine health checkup. So that is also allowed as a deductible expenditure for the purpose of calculating taxable income. This is apart from the health insurance premium which you are paying. So health insurance premium plus routine checkup which you are undergoing for yourself, for your family, the 5,000 rupees is allowed as a deductible expenditure. Now coming to the section 80DD. Section 80DD provides provision for tax deduction in two cases, with the permitted deduction being 70,000 rupees for normal disability and 1.25 lakh rupees for severe disability. What it means is, if a person is having dependent children or child who is disabled, right, for normal disability, say for example from 40% disability to say 80% disability, right, this deduction allowed is 75,000 rupees. This deduction is allowed for incurring for upbringing that person, right? If you are a dependent, you are having a dependent child, if you are having a dependent person, right? And for that, for upbringing, all of us know that upbringing the dependent, the physically challenged person is a difficult child. So if there is a disability, right, then the extra expenditure is being involved for upbringing that person. So in order to facilitate so that the more expenditure can be made on the upbringing of that person, 75,000 rupees is deductible from your total income for the purpose of calculating taxable income. If it is a normal disability, where normally we say normal disability means 40% disability to 80% disability. Severe disability means from 80% plus disability, that is called severe disability. In that case, this deduction allowed is 1.25 lakh rupees. right? So this is allowed because for payment of made towards the treatment of dependable and with dependent with disability, amount paid as premium to purchase or maintain an insurance policy for such dependent, right? So upbringing of a dependent person is really a challenge. For that purpose, the Government of India allowed to have some deduction from your total income so that your taxable liability get reduced. And this limit is, as I just said, 75,000 rupees in case of normal disability and 1.25 lakh rupees in case of severe disability. The permitted deduction is rupees 75,000 for normal disability, I have already explained, and 1.2 lakh rupees for severe. Both Hindu undivided families and resident individuals are eligible for this deduction. The dependent in this case can be either a spouse, sibling, parent or children, right? So anybody can be dependent, and not only for the child but even for the spouse, for the sibling or the parents. Section 80DD-B, right? Section 80DD-B can be utilized by HUF and resident individuals, but here our focus is on resident individuals, and provides provision for deduction on the expense incurred by an individual or a family towards medical treatment of certain diseases. We call it terminal diseases, right? The permissible deduction is limited to rupees 40,000. The deduction under Section 80DD-B for senior citizens and very senior citizens has been increased to 1 lakh in the Union Budget 2018. Means from 2018 onwards, for senior citizens and very senior citizens, it has been increased to 1 lakh in this budget from 2018. What it means is that severe disease means like for example cancer. There is a list of diseases. If a person is undergoing that ailment and getting treatment, right, not only for yourself but resident individual provides provision deduction on the expenses incurred by individual or family. Family means your dependent. In that case, 40,000 rupees per year will be deducted from your total income for the purpose of calculating taxable liability. But if the person who is being under treatment, if he is of senior age group or the super senior age group, this limit is 1 lakh rupees from the year 2018. Means it is still continuing. That from that year it is continuing at 1 lakh rupees. Not the limit is 40,000 rupees if the treatment is taking place of a senior citizen. Tax deduction under Section 80E. Why we are talking? Because you should know that under each of these sections there are various deductions which are allowed, so for the purpose of calculating taxable income. If you are incurring any such expenditure, right, so you are eligible for deduction in your taxable income, deduction from your taxable income for the purpose of calculating your tax liability. So under this provision, taxpayers are eligible for tax deduction on the interest repayment of a loan taken to pursue higher education. As all of us know that higher education has become very expensive. In a country like India also, many private institutes, many private educational universities have come up. Even the fee in the IITs and IIMs, right, which are the premium institution of this country, they are also quite expensive. I mean, in IITs, IIMs, the fee is somewhere around 10 lakh, 12 lakh rupees, right? So an ordinary citizen, ordinary income group person cannot afford to spend 10, 12 lakh rupees. So for that purpose, this education loan has become very popular, right? So for the education loan, the education interest which you are paying on this education loan, that is deductible from your income up to a particular limit. So this loan can be availed either by the taxpayer himself or herself, or to the sponsorer the education of his or her wild child. Means if I have taken loan in my own name, right, then I am also eligible. Or if I have taken education loan for my child, right, then I am also, because I am sponsoring my child's education. So only individuals are eligible for this deduction with loan taken from approved charitable organizations. When I use the word charitable organization, there are certain organizations which are providing loans at a cheaper rate of interest. So these institutions which are listed in the Income Tax Act, right? So these organizations are allowed if you have taken loan from those institutions. Apart from these, there are certain certified financial institutions, like most probably the most popularly being the banks, all the banks, right? So and financial institution permitted for tax benefit. Deduction is allowed for 8 years or till the time loan is repaid, whichever is earlier. So friends, under section 80E, if you are paying any interest on your loan, right, that is eligible for tax deduction purpose, the interest that is being paid, and that is eligible up to the 8 years or till the time you repay the loan, whichever is earlier. So friends, in this lecture I have talked about certain deductions which are allowed under the Income Tax Act for the purpose of calculating taxable income. In the next lecture also, I will be continuing with the tax deductions which are allowed under the Income Tax Act. Thank you very much.